What if I told you that there's a way to earn consistent monthly income from the stock market without all the stress and risks of trading individual stocks? That's exactly what dividend ETFs offer, and some of them have the potential to 10x your income over time. In this video, we will reveal the top 5 monthly dividend ETFs that could realistically multiply your income over 10 to 20 years through rising payouts and compounding. So, without much ado, let's get right in. So dividend income is a portion of a company's profits distributed to its shareholders. It's essentially a reward for investing in the company's stock. And you know what? Some savvy investors consistently pocket over 10% in dividend income annually, all while their money steadily grows over time. It's a smart way to invest that combines getting paid and watching your wealth increase. Now, let's see how dividends are paid to investors. When a company decides to share its profits with shareholders, it declares and pays out cash dividends based on the number of shares each investor owns. Suppose company XYZ trades at $50 per share. You own 100 shares worth $5,000. If XYZ announces a $1 per share dividend payment, you'll receive $100 in cash, 100 shares times $1 dividend. Deposit it into your brokerage account or mailed as a check. Cha-ching! It's essentially getting paid just for investing in that company's stock. The more shares you hold, the bigger your dividend payout. It's like collecting rent from being a part owner of the business. Companies usually pay dividends quarterly, but some outstanding dividend stocks and funds pay monthly. That's a nice stream of recurring income dropping into your account monthly without you lifting a finger. The dividend yield percentage shows how much cash you earn relative to your investment. For example, if a $100 stock pays $5 annually in dividends, that's a 5% yield. Between the cash payouts and any dividend growth and reinvestment, your money grows faster over the years and decades. Dividend ETFs are extremely powerful for compounding wealth over time through both income and growth. But how can you achieve this goal? Well, it's entirely achievable with the right monthly dividend ETFs. These ETFs provide strong returns and add stability to your portfolio. But which ones to choose? Let's introduce you to 5 such ETFs. They stand out for their strong dividend payouts and the potential for capital growth. So, without much ado, let's get to number 5. Number 5. Global X NASDAQ 100 Covered Call ETF. The Global X NASDAQ 100 Covered Call ETF, or QYLD, is a standout choice for investors looking to generate high monthly income. This exchange-traded fund ETF uses a covered call strategy on the NASDAQ 100 index, aiming to provide robust income by writing call options on the index while holding its stocks. Essentially, QYLD captures premiums from selling options, making it a particularly appealing option for those who want steady payouts. One of the main reasons QYLD is so popular is its ability to generate consistent monthly income. It is a big draw for retirees or anyone focused on regular income streams. By writing call options on the NASDAQ 100, QYLD ensures high income regardless of market volatility, providing a more reliable income source than traditional dividend-paying stocks. It makes it a great option for income-focused investors who want stability. But QYLD isn't just about income. Its exposure to the NASDAQ 100 means it holds shares of some of the most dynamic and high-growth tech companies out there, giants like NVIDIA, Apple, Broadcom, Alphabet, and Tesla. It gives investors a nice balance of income and the potential for capital appreciation. However, the covered call strategy does cap potential upside gains, as the ETF has to sell stocks if the options are exercised. It can limit growth compared to other equity investments. Let's break down the pros and cons of QYLD. On the pro side, the ETF offers a hefty monthly dividend yield of over 11%, providing a consistent and attractive income stream. Its income stability is another big plus, as the covered call strategy generates income regardless of market conditions, helping to stabilize returns. With its exposure to leading tech companies, QYLD lets investors benefit from the tech sector's growth while enjoying high income. However, there are some downsides to consider. The covered call strategy can limit capital appreciation, capping potential gains since the ETF must sell stocks if options are exercised. It might make QYLD less appealing to those looking for significant growth. Additionally, the strategy can be complex and unsuitable for all investors, especially those unfamiliar with options trading. Lastly, while QYLD aims to provide stable income, it's still subject to market risk and the performance of the NASDAQ 100, which can be volatile due to its heavy weight in technology stocks. Number 4. WisdomTree US High Dividend Fund, DHS. The WisdomTree US High Dividend Fund, DHS, is an excellent choice for income investors seeking exposure to high-yielding U.S. companies. As the name suggests, this ETF tracks an index of the largest dividend-paying stocks across the American equity market. What sets DHS apart is its small sector allocation strategy. By weighting its holdings towards groups like financials 24.8%, energy 17.68%, utilities 14.26%, and consumer staples, the fund taps into businesses with mature cash flows and a tendency to paying heftier dividends. These are the profit-churning companies that prioritize returning capital to shareholders. Diving into the actual holdings, the top 10 make up about a quarter of the total 385 stocks. You'll find recognizable dividend titans like Chevron, ExxonMobil, IBM, Philip Morris, Bristol-Myers Squibb, and major banks. It's an attractive mix of yield and quality that provides diversification across sectors. Now let's look at the growth potential of this high dividend ETF. If you had invested $10,000 in DHS a decade ago and simply reinvested all the payouts, your total returns would be at a cool $22,531 today. It was not a life-changing fortune, but an incredibly solid 125% return over 10 years. However, the real appeal of DHS is its ability to generate steadily rising income streams through dividend growth. With a current yield of 4.11%, a $10,000 investment will have you pocketing $411 in yearly dividend payments. However, those payouts increase yearly due to the fund's focus on dividend growth companies. WisdomTree estimates that DHS has grown its dividend by over 7% annually over the past 5 years. Assuming the growth rate continues, your $411 in dividends could double to over $800 per year in just a decade. And in 20 years, you'd be raking in a cool $1,600 plus annual income from that initial $10K investment. The one downside is DHS's 0.38% expense ratio, meaning you'll pay $38 annually for every $10,000 invested. While higher than some ETFs, this is a very reasonable cost for active management, dividend growth potential, and income stream, which it provides to income-focused investors. Number 3. Invesco S&P 500 Ultra Dividend ETF. The Invesco S&P 500 Ultra Dividend ETF, known by its ticker symbol RDIV, is designed for investors who want to tap into high-yield dividend stocks while keeping an eye on minimizing volatility. This ETF aims to track the S&P 500 Low Volatility High Dividend Index, which includes the 50 least volatile high dividend yielding stocks in the S&P 500. This strategy offers a balanced approach to income generation and risk management. RDIV is particularly appealing to those who prioritize stability in their investment portfolios. This ETF aims to provide a steady income stream without the significant price swings often seen in other high-dividend funds by focusing on the least volatile, high-yielding stocks. RDIV is an attractive option for retirees and conservative investors seeking reliable income. One of the standout features of RDIV is its diversified sector exposure. The fund invests significantly in financials, utilities, and consumer staples, sectors known for their stability and resilience, especially during economic downturns. This defensive investment approach enhances the fund's appeal to risk-averse investors. For example, top holdings in RDIV include well-known names like Best Buy, Pfizer, and Philip Morris International, which offer both high dividends and stability. On the positive side, RDIV offers a high dividend yield of around 4.3%, providing investors with a consistent and attractive income stream. The fund's focus on low volatility stocks helps to reduce overall portfolio risk, making it a safer bet compared to other high-yield options. Its significant investments in stable sectors like financials, utilities, and consumer staples also provide extra protection during market downturns. However, RDIV's heavy weighting in certain sectors, such as financials and utilities, can reduce diversification and expose the fund to sector-specific risks. RDIV's performance could be negatively impacted if these sectors face challenges. Number 2. JPMorgan Equity Premium Income ETF. The JPMorgan Equity Premium Income ETF, JEI, is an attractive option for income investors seeking an extra boost. With a juicy 7.37% dividend yield, this fund employs a covered call strategy to generate additional income streams. Here's how it works. JEI holds a portfolio of large-cap U.S. stocks, just like a typical equity ETF. However, it also uses an option strategy of selling covered calls against those holdings. By selling call options and collecting the premiums, the fund can enhance its overall yield and return for investors. The covered call approach provides some nice benefits. First, those premiums act as an income kicker on top of any stock's dividends. It's like getting paid twice for the same shares. Additionally, the covered calls can help protect the downside during market pullbacks. Investors need to understand some risk to this strategy. Those option premiums can dry up temporarily if the market sees really low volatility. In extremely bullish conditions, the upside may be capped if the stocks are called away from the fund. As for JEI's actual holdings, they are chock full of high-quality dividend payers and growers. The top 3 weights are Meta Platforms at 1.76%, e-commerce titan Amazon at 1.75%, and the venerable industrial company Trane Technologies at 1.70%. With over 100 other stocks beyond that, you're getting solid diversification. The proof is in the pudding, though. Even including last year's challenging market, JEI has still managed to return 6.63% for investors over the past 12 months. When you combine that capital appreciation with the 7.37% yield, we discuss potential double-digit total returns. There's a lot to like about this JPMorgan fund. The covered call strategy boosts income, while the large-cap equity holdings provide stability. With rising interest rates, having an income generator like JEI in your portfolio can be smart. Be mindful of the potential trade-offs during periods of low volatility or extreme bullishness. However, JEI's strategic approach is worth considering for investors seeking an overall mixture of capital appreciation and high monthly income. Number 1. X SuperDividend ETF. Let me tell you about a fund that could be an income investor's dream come true. The Global X SuperDividend ETF, ticker symbol DIV. It is all about maximizing those dividend payouts by holding some of the highest yielding stocks from around the globe. We're talking about companies known for sharing the wealth with their shareholders in a big way. Now, the key thing that makes DIV so enticing is its strategy. Instead of blindly chasing yield, it weights 50 super dividend payers across different sectors and regions, so you get a high 6% yield and great diversification to spread out your risk. Speaking of that distribution, let's discuss the income stream DIV cranks out. You're paid monthly, which is crucial for managing cash flow. Imagine an extra $600 dropping into your account monthly for every $10,000 invested. That's the power of DIV's dividend focus. As for what you own, the fund includes financial companies like Virtu and old-school manufacturers like International Paper. That broad mix of dividend titans helps ride out volatility in any stock or sector. Now, there's a couple of potential downsides to be aware of. With such a high yield tilt, you may not see explosive capital gains like a growth fund. These companies tend to be more mature. There's also the risk that if a business hits a revenue slump, that fat dividend could get cut. But if your priority is collecting consistent monthly income from stocks, DIV should be right up your alley. That 6% yield removes what you'd make from bonds or a savings account. And with portfolio diversification, you're not overtly exposed to any dividend dud. With that said, let's wrap it up. Stay tuned and subscribe for more amazing videos.